All right, legacy tech giants or cutting-edge AI powerhouses. What happens when an absolute titan like Alphabet prints a blockbuster 24% revenue growth, but the stock, wait for it, takes a hit? Are we looking at the absolute buying opportunity of a lifetime, or are we trying to catch a falling knife that is headed straight for the basement? Today, we are going deep. Grab your coffee, pull up a chair, and let's answer the ultimate question. Is it time to buy Alphabet?
Before we get into today's video, did you know you can request the next stock I analyze? Just drop a super thanks with a ticker. Any amount gets you in the lineup, or $6.98 guarantees your pick within 24 hours. Remember, I focus on fundamentals, not meme stock hype. And now, back to the video.
Now, check this out. Wall Street can't make up its mind about Google, and it is fascinating to watch. On one side of the battlefield, you have got the bears, and they are out here screaming about hyperspending. They look at that jaw-dropping $44.9 billion CapEx bill for the quarter, which is pushing full-year projections to an insane $195 to $205 billion, and they are terrified of margin contraction. They see the negative free cash flow of minus $5.9 billion, and they start sweating. They say, hey, look, OpenAI and Anthropic are shipping faster, Gemini 3.5 Pro is getting delayed, and the costs to run these massive AI models are going to destroy Google's profit margins. But then, look at the bulls. The bulls are pointing to a mind-blowing cloud backlog of $514 billion. $514 billion. That is contracted future revenue, guys. They see Google Cloud absolutely exploding by 82% to $24.8 billion, utterly outpacing both Azure and AWS this quarter. Search revenue is still a cash machine, growing 17% to over $63 billion, and YouTube is pulling in $11.1 billion. Plus, let's not forget those massive paper gains from
their Anthropic and SpaceX stakes that boosted net income. This is a classic battle of short-term cash flow anxiety versus long-term AI dominance. The market is acting like Google is spending money on a whim, but management is literally building the railroad of the next century. Before we talk numbers, let's take a step back and look at who Alphabet actually is today. This is not just your parents' search engine anymore. Yes, they dominate search globally, and yes, Chrome, Android, YouTube, Maps, and Google Photos are integrated into the daily lives of billions of active users. But Alphabet has evolved into a three-headed beast: Google Services, Google Cloud, and the moonshots they call other bets. Google Services is their massive cash cow, monetized through ads, subscriptions, and hardware. Google Cloud is their high-speed growth engine, providing enterprise-grade infrastructure, databases, and cutting-edge artificial intelligence to corporations worldwide. Now check this out. Management's forward-looking guidance is incredibly optimistic. They are telling us that the massive CapEx doubling is not wasted money. It is the direct response to unprecedented enterprise demand for AI infrastructure. They are building custom AI chips, scaling their Gemini ecosystem, which already has 950 million monthly active users, and securing future business. The market is pricing in structural decay, but management is painting a picture of an unassailable tech ecosystem that is front-running the AI revolution. The disconnect here is massive. So how do we reconcile this massive Wall Street panic with management's actual long-term guidance? Well, we ran the numbers, and we have built three distinct scenarios to see where this stock is really valued. Let's start with our base case, which we are assigning a 50 massive cloud wave, but that heavy capital expenditure does act as a short-term drag on profit margins. If we run our model starting with the current EPS of $13.11, and we project a moderate forward one-year EPS growth of 15%, which takes into account that heavy CapEx drag, we get a forward EPS of $15.08. Now let's apply a standard reasonable forward PE multiple of 25 times, which perfectly reflects their massive cloud backlog and search mode. Multiply 15.08 by 25, and we arrive at a fair value of $377. That is a solid 15% upside from where we are trading today, showing that the long-term fundamentals are highly supportive once the CapEx panic settles down. But what if the doubters are totally wrong? Let's look at the bull case with a 25% probability. In this scenario, AI monetization accelerates like crazy. That massive capital expenditure pays off immediately, proving the bears wrong. Cloud growth continues to soar and search margins stabilize. For this, we project an aggressive forward EPS of $15.99, reflecting a 22% growth rate.
Applying an elevated PE multiple of 28 times because Google would be crowned the king of AI infrastructure gives us a fair value of $447.72. That is a major breakout, but to get there technically, the stock must clear its major resistance at 370. Now, we have to be realistic, right? What is the bear case? Also a 25% probability. Here, the heavy infrastructure spending continues to compress margins. Gemini delays allow rivals to steal search share, and that negative free cash flow gets uglier. Under this pressure, we project a conservative forward EPS of $13.77, just 5% growth. Apply a compressed forward PE of 21 times due to structural fears, and our fair value drops to $289.17. If the technical support at 333 cracks, the chart says we are almost certainly heading down to test this bear territory. So the range is wide, but the odds are heavily skewed to the upside. Let's pull up the chart and look at the technicals, because the price action is telling a very clear story right now. If you look at the daily and weekly charts, GOOG has been locked in a stubborn multi-week downtrend channel. It has been sliding since April amid broader tech sector volatility, currently sitting at $341.91. Look, the trend is your friend until it bends, and right now, the bears have control of the short-term chart. But here is the key. We are sitting just above some absolutely critical support levels. The first line in the sand is at $333. If the bulls can defend 333, we form a beautiful base. If that level breaks, the next major historical support sits at $324. If we break below 324, watch out below, because that opens the trapdoor to our bear case. On the flip side, what does it take to get the bulls back in charge? To completely invalidate this downtrend channel and resume the primary uptrend, the stock absolutely has to reclaim and maintain above the key resistance at $370. Once we clear 370, it is blue skies back toward the 52-week high
of 404. All right, retail family, this is the moment we've all been waiting for. Let's weigh the evidence and deliver the final verdict. Is the bottom in for Alphabet? Well, my honest assessment is we are incredibly close, but we aren't completely out of the woods just yet. The risk-to-reward ratio right here at $341 is highly attractive for long-term investors. Why? Because you are buying an absolute monopoly with an 82% growing cloud business at a discount just because short-term traders are scared of capital spending. For long-term investors, this is a screaming buy. But for short-term swing traders, you need to exercise a little patience. Until we see the price action find firm support at 333 or break out above 370, there is still short-term downside risk. So, the long-term bottom is likely forming right here, but expect some choppy water in the immediate future. If you were looking to build or add to your position, here is exactly how I would tranche my buys. I wouldn't go all in at once. Instead, set your first buy limit order right around the current level of $338 to $341 to catch the immediate support. If the market gives us another dip, place your second, larger tranche right at that major $333 support level. And if we get a broader market flush and touch 324, that is your high conviction zone to load up. By scaling in at these precise levels, you protect your downside while positioning yourself beautifully for the inevitable march back to our $377 base case target. Before you go, do me a huge favor. Smash that like
button if you got value from this breakdown. And make sure you hit subscribe so you never miss an episode of Is the Bottom In? Drop a comment below. Are you buying this Alphabet dip, or are you waiting for 324? Let me know your price targets. And finally, remember, I am just a guy on YouTube sharing my personal financial research, not your certified financial advisor. Always do your own research, manage your risk carefully, and never invest money you cannot afford to lose. Trade smart out there.